My name is Lowell Walters, and this is my third part in a series on executive benefits compensation, rewarding employees you cannot afford to lose. I'm an attorney at Carlton Fields focusing on employee benefits, and in part one, we talked about ways you can decide whether an executive benefits program is right for your company, and in general, what employers can do to reward a few high-ranking employees. In part two, we talked about which employees should be included in an executive benefits program. And in general, we concluded that it's employees that you can't afford to lose and who will appreciate what the company is willing to offer, whether the company is looking to offer stock ownership in the company or looking to provide cash. Certainly keep in mind that your business can offer multiple arrangements. It can offer a stock arrangement to some employees, offer a cash-based arrangement to other employees. So there is flexibility there, but the key is that if you want to give your employees something to appreciate and stay with your company and be grateful for working at your company, make sure that what they want and what you want to provide are consistent. In this part three, we're going to talk about the simpler options that are available. Regular pay increases, bonuses, deferred compensation, and some stock-based cash arrangements. I think that it's important that you start thinking this through with the simpler options and only move on to the more complicated ones if you think something about a simpler arrangement just will not work for your circumstance. So with regular pay, that of course is very, very simple. Very easy to understand and explain, get the appreciation for it, minimal documentation needed to increase someone's salary, and you will rarely need significant legal advice or other advice to get that done. Some of the drawbacks, it is an immediate tax hit to the employee if taxes are a concern. It is also a recurring benefit. If you raise someone's salary, it's not expected that you're going to raise their salary for 1 year and then it goes back to what it was before. If it goes back to what it was before, that's viewed as a pay cut, and it's viewed very negatively. So this is a recurring benefit, which could be a problem for some companies, or maybe not what you're looking to do. There's also no real penalty or forfeiture of amounts if an employee ultimately does leave. Yes, they forfeit their future salary, but a lot of companies want something additional in there. Now, with bonuses and incentive bonuses, right, you can require some future service. Rarely do you require more than a year of service. Someone becomes entitled to their bonus at the end of the year. So if they leave during the year, yes, they lose out. And that's also why a lot of people tend to change jobs January, February, March of the following year because they want to stay and collect their bonus. So let's see. Bonuses have a similar drawback to cash compensation in that there is an expectation that the bonus will be recurring. They'll have an opportunity to make that bonus each and every year, which again may not be what the company is looking to provide. Bonuses provide, I'll call it an insignificant deferral opportunity. Certainly, if let's say you have for the year 2020, someone earns a bonus and it's paid out in early 2021, you could view that as a 1 year salary deferral. Certainly, it's not a significant salary deferral that will satisfy anyone that has a concern or wants to minimize their tax hit. Non-qualified deferred compensation. These are very flexible arrangements. Just to give you an idea about how flexible they can be, in terms of funding, you can fund these with employee salary deferrals. And actually, if you have a situation where not all of your employees are able to salary defer, or some of their salary deferrals are getting kicked out because of failing, let's say, ADP, or some top-heavy issues, you can allow those employees to put money into a deferred compensation plan. Similarly, maybe you don't have that problem. Maybe you have a safe harbor 401k, or for whatever reason, these employees are able to salary defer the maximum amount permitted by law, but they want to put in even more. You can fit more in this non-qualified plan. And then in addition to salary deferrals, it can accept employer contributions. And you can base those employer contributions on time worked. For every year you are here, the employer puts in X, or for every year that you are here and work a certain number of hours, you put in X. It can be some sort of an incentive, like a company goal. Company sales have to reach a certain threshold, or some other kind of achievement. All right. It could also be a match. Maybe the situation is your 401k plan is fine. They're able to put in whatever they want in the 401k plan, but the company isn't making a matching contribution to the 401k, and you want to make a matching contribution, but just for these employees. Well, that match can go into this deferred compensation plan. Let's see. Another benefit, deferred compensation arrangements often have vesting and forfeiture provisions. Now, with salary deferrals, usually what they salary defer, they can't forfeit those amounts really. But what the employer puts in, let's say you were to tie this in to an employment contract. Maybe the employment contract's going to run for 5 years, and you as a company can put money into a non-qualified plan and say you need to satisfy the terms of your employment contract. If you leave before the 5 years is up, you forfeit the deferred compensation plan. So you can have that penalty, or the stick, in terms of carrot and the stick, with deferred compensation plans. Let's see. This does provide for delayed taxation. Taxes are due when the employee is paid or is entitled to be paid. So if the deferred compensation plan is going to pay out when the employee terminates employment, you've got a deferral opportunity until they terminate employment. If it's going to pay out in 5 years, well, then you have a 5-year deferral right there. And it's different from a 401k plan, where you set up different times when an employee can request a distribution. Common ones are age 59 and a half and termination of employment. But the employee can reach those time thresholds and say, you know what, I don't want my money, let it ride. That's under 401k. Deferred compensation plans cannot do that. The distribution timing must be set up in advance. Now, I did say these are flexible, and let me just give you an example of how you might structure an arrangement that's, let's say, tied to an employment contract. You're letting the employees salary defer as much as they want into the deferred compensation plan. On top of that, the company agrees that if the employee works for the company for another 5 years, they will get an additional $30,000 through the deferred compensation plan. Now, 5 years comes, the employee is going to get $30,000. They don't want to be taxed on $30,000, right? In general, the easiest thing to do is, yes, go ahead, do distribute the $30,000 to the employee, but the employee can then increase their salary deferrals in the deferred comp plan, increase that by $30,000, so their net income tax is going to be the same. They will have, in essence, deferred that. And maybe you'd put in a provision that while the employer contributions get paid out in 5 years when the employment agreement is satisfied, salary deferrals don't get distributed until termination of employment. So that can work nicely. That can be a nice arrangement for a lot of employees. Deferred compensation arrangements can be made absolutely clear that they are not providing recurring benefits. In my past example, it said that if the employee stays with you for 5 years, they get $30,000. That clearly is not a promise they're getting $30,000 per year, or even that at the end of that 5-year period, if they renew, that they'll get another benefit in 5 years. That would be to be negotiated. So these can easily be structured as non-recurring benefits. All right. In addition, one of the reasons you can keep that forfeiture opportunity for a longer time than in a 401k plan is because funds are not held in a separate plan account. Funds are held in the company's general fund. Or if you want to separate it out for your convenience, it would be a separate account still owned by the company. When participants have a right to deferred compensation amounts, they are unsecured creditors. All right, and they don't have the enhanced collection or creditor rights that they would as 401k participants. Now, of course, both of these benefits from the company's perspective are drawbacks, maybe significant drawbacks, to the employee's perspective. If your employees have concerns about this, there's a concept known as a Rabbi Trust. And for now, I'll just say the goal of the Rabbi Trust is to set up a structure so that these employees have more comfort that the funds will physically be in an account when it's time to pay them out to those employees. Let's see, drawbacks with deferred compensation plans. Number one, they are tax documents, and you should have a tax attorney or another tax advisor there to prepare the document and address any issues or concerns that may arise. I forget if I touched upon it yet, but deferred compensation benefits are subject to income tax and employment tax when distributed. If the arrangement is not drafted properly, you can add another 20% excise tax on top of all that. That's pursuant to Internal Revenue Code Section 409A. All right. And it's also a drawback that they are less flexible with payouts. We already talked about how the timing of the payout needs to be preset. In addition, the form of the payout needs to be predetermined. Now, for example, you might, let's say, in addition to an employment contract, or maybe there isn't an employment contract, but there is a non-compete. All right. You can structure this so that the employee might be vested when they terminate employment, but you're actually not going to pay out any deferred compensation money until, let's say, 2 years after the termination of employment, because there's a 2-year non-compete. And then after that 2 years, maybe you start to pay out quarterly. All right. You can do that. It just needs to be predetermined. All right. And what's more, what you can do to show that these are flexible, even though it has to be thought of in advance, is maybe if the employee terminates employment because of disability or death, you're not concerned about them competing. So you could say, there'll be no payouts for the first 2 years. After 2 years, there's maybe quarterly installments until it's fully paid out 5 more years from then, unless you terminate employment because of disability or death, in which case there will be a lump sum payment when you terminate employment. So you do kind of have the flexibility, but it needs to be set up in advance. That's the idea. All right. And when you do pay out, which again can be years later, because this can provide a nice deferral opportunity, these are reported on a W-2, all right, because it is ordinary income, even if this person has been a former employee for 7 years. Last drawback I'll touch on today has to do with pass-through entities. You might remember I mentioned that assets to pay benefits are part of the company's general fund. Now, if you're a pass-through entity, the underlying shareholders, the underlying owners, are taxed on any entity assets remaining at year end. So as you're building up that fund to preserve and pay benefits, those underlying owners will be taxed on it, which is a significant enough problem that pass-through entities rarely use deferred compensation plans. All right. Now, let's move on to the last kind of arrangement, which is stock-based arrangements that don't usually transfer stock. These often go by names like restricted stock units, phantom stock awards, and stock appreciation rights. All right, these are arrangements where the participant normally gets cash equal to the value of stock or equal to the value of a change in stock price once a goal is met. All right. In a way, you could think about this as a performance bonus, but instead of calculating someone's performance bonus based on sales or based on an organization's profits, it's calculated based on the stock value or the change in stock value. Now, of course, with these arrangements that provide cash, the cash can be then used to buy stock. And actually, if you do arrange to provide stock, you can allow them to sell the stock back to the company for cash. So again, there is flexibility like that. In general, these arrangements provide for the award of cash, not stock. And when it is paid out in cash, it's ordinary income tax. So now you know some details about ways you can reward your more important employees without providing an ownership interest in the company. In our next installment, I'll focus on stock-based arrangements. If you have any questions or comments about this video, please share them. And for more information, you can visit carltonfields.com or don't hesitate to contact me at lwalters@carltonfields.com with general benefits questions or suggestions for future videos. Thank you.